Hi everyone, good morning. We'll just take another 2 minutes. We'll let rest of the participants assemble and then we'll begin shortly. All right, then let's get started. Good morning, everyone. Wish you all a happy new year. Welcome to the first session of 2026 as we resume our series, Decipher with Deserve. In today's session, we will take a quick look at 2025, recap our learnings, discuss our outlook and recommendations for 2026. 2025 was an eventful year, be it geopolitical events, economically, and for the markets as well. Beyond all of that, for Deserve as well. To guide us through all of this, for the very first time, we have not one but two of our co founders, Vaibhav Porwal and Sandeep Jetwani, joining us. Welcome, Vaibhav and Sandeep. We are really looking forward to the next 60 minutes.
Thanks, Hardik, and Happy New Year to all our attendees.
Hi,
Thanks,
Sandeep.
Hardik. Hi, Vaibhav, and happy 2026 to everyone. We've started on an interesting note on the back of what was a very, very interesting 2025. And I'm approaching this webinar with nervous excitement, given that I'm returning to the series after a very long time.
Great. Welcome back, Sandeep. Sandeep, before we get into markets and macros, let's start close to home. 2025 was a defining year for Deserve. Would love to take our audience through some of the highlights.
Hardik, it'll be great if you can navigate. But I think we approach and we approach end of 2025 with a lot of gratitude for the trust that our clients have placed in us. In every metric, our clients helped us grow very dramatically. We more than doubled our number of clients that we serve. We went from almost 2,400 clients to about 5,500 in this period. Our assets under management scaled almost about 50 odd percent in this period, scaling from 10 odd thousand crores to 15,700 crores. We're closing in on 16,000 crores as we speak. Our flagship strategies also grew very well. So, Equity Revival Strategy, which is our flagship equity strategy, I think has now crossed more than 6,000 crores in assets under management. When we started this strategy, given that it is comprised of mutual funds, there was enough skeptics on whether the strategy will be able to deliver returns. And I think we'll talk more about that just in a bit. The Dynamic Debt Plus strategy, again, very unique in its own category, has also done remarkably well, but also scaled to more than 1,000 crores, almost the first of its kind in the category. We used 2025 also to launch a bunch of new initiatives. Our allocation to gold, silver, or precious metals through what we call Shine, which is strategic holdings in natural elements. We launched that particular strategy. Stability Reserve, we'll talk more about that. We've also now scaled the Smart Tax Balanced strategy, which is more multi-asset in nature. We also took to market a very unique concept called the Deserve Constellation Fund, which enables access for our clients to top boutique fund managers in India through a fund of fund route. And I think we are very gratified by how clients have, taken that to their portfolio. If you look at actually some of the high level, performance metrics within the PMS category, our debt strategy, which is Dynamic Debt Plus, is now the top performing fixed income strategy with more than 1,000 crores in AUM in its category. I think that is a remarkable achievement given that it is a granular strategy. It's highly diversified, so very high focus on risk management, but the number of clients is also very large. Equity Revival is now the fifth best performing equity strategy with more than 5,000 crores in AUM. I think here it's very important to understand that we have built this strategy on the back of mutual funds. One of the best regulated and most tax efficient instruments to take equity exposure in India. And with that, we are in the top five. And also, we crossed broke into the top 10 portfolio managers of India on the discretionary side just in about 3.5 years since we got our license. One of the interesting things that as we've been looking through to 2025 is that we are now trusted by more than 7 lakh individuals with their portfolio information where we analyze that data and give them insights. 3 lakh such investors joined that cohort in 2025 with portfolios of more than 1 lakh crore. So I think all in all, very, very grateful to clients who have trusted us with their hard-earned capital. These are Indian wealth creators who have created wealth through sheer dint of effort and intelligence. And the fact that they can trust us with some of that is something that's very gratifying for us. Hardik, I just thought it'd be interesting for our clients to get a behind the scenes look on what we do on the technology and the AI side. I think today no conversation can be concluded or begun without a reference to AI. So I'll come to that. But the teams at Deserve have built significantly scaled systems. So just in last year, we've processed over 7 lakh unique transactions. Our payment systems have gotten robust and very time efficient also. So 60% of incoming payments are settled instantly. We are able to process over 15,000 orders on a daily basis. While building for scale, data security, information security is a core tenet of our promise to our clients. So we are ISO 27001 certified for information security. We are SOC 2 Type 2 certified, which is a high bar on audit that is placed on us. And our advanced encryption systems ensure that data is secured almost like a bank grade security at our end. On the AI side, I'm absolutely excited that we are now able to build an institutional understanding of each one of our clients. So all interactions that clients have had with us, we are able to synthesize and be able to serve our clients better. The objective is we never forget what you tell us. The objective is that we never miss out on an action that you've instructed us to take. So I think that's some work that we're doing. And while we serve our clients, I think the people who actually represent Deserve are our relationship managers. And how do we enable them to be able to serve our clients better, spend more time with our clients using these AI systems has been a top priority for us. So I think all in all, it's been a busy 2025 at Deserve, and we're just getting started.
No, thank you, Sandeep. You want to cover the uh, list of services, the solutions that we provide. You obviously briefly covered it. I'll give you another minute to sort of run the audience through all the solutions that we have on offer.
Hardik, in the course of the last year, we actually took major strides in becoming a full-fledged solutions provider on the wealth management side. We want to truly become a complete partner on the investment side for India's wealth creators. And in that journey, on the equity side, we've already referenced the equity revival strategy, which is now over 6,000 crores. Alpha Focus, which focuses on the small and mid-cap category, a category that we were under investing consciously in the last year, but the strategy exists and has done reasonably well. I spoke earlier about the Constellation Fund, which is the category three fund of fund. Again, asset that is scaling for us. On the fixed income side, the Deserve Dynamic Debt Plus, one of the top debt strategies in India, the arbitrage strategy for temporary deployment, but also now stability reserve, which is a very tax efficient strategy for short term deployments. And I would encourage our clients to talk to their relationship managers about this as well. On the alternative side, we spoke about Shine, which takes exposure to gold and silver. I'm very enthused by the fact that how the team was able to dynamically reallocate between gold and silver at the right time. Infra yield, which takes exposure to real estate, InvITs and REITs, again, a strategy that has done very well for us. And smart tax balance, which is a multi-asset strategy. Our promise for 2026 is we'll keep adding to this uh, list of instruments. We are guided more by what is right for the client as opposed to what is the flavor of the month. And in that, taking sort of some views ahead of time becomes very important.
No, thank you, Sandeep, so much for taking us through the year gone by for Deserve. 2025 for us, as you mentioned, was not just about returns, but about building the platform and infrastructure set for scale, establishing investment discipline, and building client trust. Uh, from there, we'll pick on to the macro events that occurred in the event 2025. Above this segment, we would like you to cover to understand portfolio outcomes. Of course, we need to understand the backdrop from where we are coming in. Uh, of course, 2025 had several macro and geopolitical cross currents. What really mattered for markets, Weber?
Uh, 2025 was very busy at Deserve, but equally busy in the market also. We were hit by what I like to call as a Trump-nado. So not a tornado, but a Trump-nado, which kept us on our toes throughout the year. So Trump's Twitter handle has become the most followed indicator for market investing. There are multiple announcements which keep happening, but four which clearly demonstrates the kind of volatility which he has are mentioned here. On April 2nd, you remember he slapped tariff and he called it the Liberation Day for America. Within 7 days, he flipped. And I remember we had our Mumbai client event, and everyone was worried about that. And as we were approaching the end of the event, there was an announcement that he has taken a pause for 90 days. 90-day window got over on July 31st, and everyone took a sigh of relief. But on August 6th, he came up with a new idea of additional tariff on India because we were importing oil from Russia. So that continued and that impacted all the asset classes in different ways. India obviously had a slightly better year compared to a lot of other markets in terms of stability because of our macro stability. Uh, but still, obviously, we had high volatility in the market. Government ensured that domestically, whatever we could control, they controlled both on monetary as well as fiscal front. There was a lot of support provided by the government. Two large initiatives, and none of us had budgeted for these. Reduction in individual tax rate and also a big bounty in terms of GST tax cut. Both of these put together gave a uptick of 0.5% to GDP, and it also set the base for what we are expecting for 2026. Tremendous achievement by the government. While maintaining high fiscal discipline, they were able to create enough growth impulses in the economy. And we are seeing the evidence of that. And some of that data may not be captured in this PPT, but when we look at consumer discretionary sales, post reduction in GDP, it's extremely encouraging to see the kind of numbers that we are seeing. RBI also did its bit. Obviously, they infused a lot of liquidity in the system with CRR cut. This in last 2.5 decades, only second time RBI has done this by reducing CRR rate, almost infusing 3.5 to 4 lakh crores of liquidity in the system. At the same time, a lot of buffer on interest rate side also to ensure that cost of capital for both households as well as corporates go down. Reduced repo rate substantially by 125 pips. What these measures did was to stabilize our GDP growth, but still impact on the market was not felt as positively. We saw a fairly muted equity market. September 24 is when we hit 26,200, which was the peak of the market. All throughout the year, Trump ensured that we enjoy serious bouts of volatility. And after all those volatility, we settled back pretty much at the same levels at which we were there in September 24. Now, obviously, at the surface level, when we look at the data, markets have remained flat. But within the market, also, there are multiple changes which have taken place. So, category shift. You remember we released a note around December of 24, projecting large caps to be a big outperformer in current calendar year. And as it turned out, large caps were the best category for 2025, 10.2% performance versus mid cap 6% and small cap negative 5%. In fact, we liquidated all our small cap positions to ensure that we were present only in large cap and mid cap category. Besides that, also, if you look at stock specific correction has been fairly sharp. Median correction in Nifty, median stock price correction in Nifty 500 stock is almost 20%. So, which means more than 50% stocks have corrected by more than 20% or more. And as you keep going down the market cap ladder, the correction is steeper and steeper. Beyond 500 stocks, the correction is as large as 40 to 50% in stocks. So obviously, it's been a fairly interesting year where when we look at the market levels, the correction doesn't become apparent. But when you dig deeper and go beneath the surface, the correction has been very deep. Another big theme which was popular in 2025 in equity market was number of IPOs. We saw 360 IPOs, which is virtually one IPO every day, and almost 2 lakh crores worth of capital was raised. A lot of excitement around some of these IPOs, but unfortunately, the performance has not been great. Median return is zero, so all the stocks uh, when we look at them, more than 50% stocks have delivered zero or negative returns. So which means in terms of IPO investing experience was not great. We have stayed away from that category completely. Other thing which I'm really excited about is the way we handled our fixed income allocation. The impact of all the Trump policy has been that US interest rates have not come down despite aggressive interest rate cut by Fed also, and which ensured that despite aggressive rate cuts by RBI in India, 10-year GSEC yield has seen a contraction of only 10 basis. We had guided our investors to stay away from duration and focus much more on accrual strategy to ensure that we are able to accrue 10% plus kind of returns, which were available in the market in high quality bonds and which we captured through our triple D plus strategy, which worked out in our favor. So this is what we were anticipating, that there won't be a significant appreciation in long duration bond prices, and therefore investors were better served with accrual strategy. One category which kind of surprised everyone was precious metal, largely a function of central banks moving away from dollar assets to non-dollar assets, plus a lot of speculative as interest buildup also. So silver prices have seen multiple 10% ups and downs, and which is clearly an indicator of what kind of speculative interest which is getting built. Some precious metal performance will continue over a long period of time as we keep moving towards de-dollarization, and we continue to believe that investors need to have allocation to precious metals in their portfolio. So these were some of the highlights of the year which had gone by.
No, thank you, Weber. That was quite comprehensive, with obviously detailed view of the geopolitical scenario, the macro, India macro backdrop, both on the fiscal and monetary side, as well as performance of different segments of the capital markets. Before we move on to the next segment, a friendly reminder to our audience, there is a Q&A box where you can start posting your questions. We will try and address as many questions as possible at the end of the webinar. Moving on, Sandeep, in this backdrop, of course, very eventful year, as Webo mentioned, host of events that occurred both geopolitically as well as domestic on the macro, fiscal as well as monetary front. Uh, what were some of the investment and portfolio decisions that we took at Deserve? What went right? What were some of the learnings that we could pick from there?
Yeah, I think Hardik, last year was a crazy microcosm of what typically happens in markets over a very long period of time. But I think it's also important for us to take a step back and assess how we have done. And the idea with this webinar, and hopefully we'll do it every year, is to be candid with our clients and transparent about what we did well and also what we didn't do well. Now, on the equity side, as Weber mentioned, the markets were flattish, but large caps held up. I think one thing which our team did exceptionally well is that oriented the portfolios very heavily in the direction of large cap. It's important to recognize that the strategy is given over 7 odd percent return in the last 2025 in the context of the fact that the average stock more less than 10,000 crore market cap is down by more than 25%. I think keeping this in context, that play worked out well for us. Our focus on short-term bonds through the dynamic debt plus strategy also played in our favor. We could have easily had long-term bonds, but long-term bonds did not benefit in yield correction, and therefore the performance would have nowhere been close to what we were able to deliver, which is a early teen performance of 13% performance in the deserved dynamic debt plus strategy. When we look back at the precious metals, and I think Weber mentioned the fact that this surprised all of us in terms of the ferocity of the upside that was seen here. Here, we could have, in true candor, allocated more capital or recommended allocations of more capital to our clients. And the last thing was the unlisted side. So there's a lot of excitement in our industry around pre-IPOs, etc. But as Vaibhav's deck showed that the pre-IPO investments wouldn't have done as well as the excitement around that was. So I think avoiding some of those aggressive recommendations in unlisted equities, I think played to our favor. So I think overall, we were able to deliver reasonably high quality return while controlling risk with the potential of having allocated more money on the precious metal side.
Fair. Thanks, Sandeep. That was quite a candid walkthrough through what worked for us and what were some of the learnings. Clearly, we believe in transparency about what did not work while celebrating what worked. Moving on, let's shift gears to the year in focus now, 2026. We have a lot of anxiety building in given how markets have fared, given geopolitical pressures, etc. When you look at 2026, what are the big macro and geopolitical variables to look forward to, especially while considering your investments and portfolio allocations?
See, geopolitics is slightly tricky right now, and we're seeing a lot of volatility. Russia and Ukraine war doesn't seem to be coming anywhere close to an end. So it's been more than 3.5 years. Plus, there are other pockets of uncertainties which are building up. Good thing for India is that to a large extent we have remained insulated from that directly. Indirect impact has been there. And second impact that India is facing right now in terms of risk, and I wanted to talk about the risk at the outset before covering why we will remain insulated and will continue to do well is the entire uncertainty around tariffs. So these are the two big geo global situations which warrants a lot of attention. But India honestly is placed really well. In my last 20-25 years of career, I have not seen these kind of macros. Supremely strong macro situation we are in. If you look at the balance sheets, and we'll talk about the earnings also. If you look at the balance sheets, government balance sheet is extremely healthy. We are pretty much on track to achieve our fiscal deficit number. Corporate balance sheets, corporate leverage is extremely low, so which again gives a lot of buffer. Banks balance sheets, NPA levels are at decadal lows. Household balance sheets are looking all right. Obviously, household borrowing numbers have gone up, but still very much in a comfortable range. One big indicator that I'm seeing of growth is uptick in credit growth. So after a long period of time, we are seeing 12-13% credit growth number, which is indicative of the fact that demand for capital has started picking up. So which will mean two things. One, growth should happen, and also corporates will start borrowing money for Capex. So these are early indicators. And result of all of these is much better earning growth. Earning growth, if you look at last 6 months, all the earnings which have come out are much better than what the markets were expecting. So we are ahead of a situation where we were seeing earning downgrades. Last two quarter earnings have been fairly good. And this quarter also, we continue to expect the same. Next year, I expect 15% earning growth. And given that valuations are trading at an average levels, your return should be similar to what the earning growth will be. Government has done a lot of initiatives, and we spoke about it that the foundation work for 2026 was done in 2025, and this year is something where we'll reap some of the benefits of that. One additional element which will be in play for current year for us is implementation of eighth pay commission, which releases about expected to release about 2.5 to 3 lakh crores of additional money in the hands of government employees. So that's almost like 0.7% of GDP. We have seen in the previous cycles when these pay commissions were implemented, the impact on consumer discretionary spending was disproportionately large. And this happens ahead of the curve. So when the implementation happened in 2008, 2006 to 7 itself, there was a big uptick in consumer discretionary spending because people spend ahead of the curve. When they anticipate that the cash flow is going to come, they spend ahead of the curve. Similar trend played out in 2016-17 also. So expect a big boost in consumption from 8th pay commission. So now for consumption, and government has smartly focused on ensuring that domestic consumption remains in a healthy situation, because global situation is something which is less under our control, but domestic economy is something that we can control, and thankfully for us 70% of our economy is domestic.
Mistake.
So we are beginning to see large part of growth opportunity there. And as I said, valuations trading at an average means that your return should pretty much be equal to what the earning growth is, which is 12 to 15% return in equity. Uh, Last factor is liquidity, and there's a lot of noise around FIs pulling out money. But when we look at the numbers, they create a very different picture. So last year, FI sold $18 billion worth of Indian equity. Domestic investors invested about $90 billion worth of liquidity in equity, so which is 5x of what the FIs pulled out. December also has seeing the number today, 31,000 crores of SIP inflows, highest ever. So numbers from domestic liquidity are extremely supportive for the market. So when I look at balance sheet, when I look at valuation, when I look at earning growth and liquidity, all these parameters are looking extremely healthy for India, and that can only mean one thing, that we'll see healthy equity returns in 2026. So
Uh,
that's what the only thing which will change is market will become more stock specific, and investors will have to manage their portfolio actively. We at Deserve continue to take active calls on the portfolio to ensure that we move in the segments of the market which are likely to benefit from the tailwinds, and that is something that investors will have to keep focusing on. We ensure that all these changes are integrated in the client's portfolios ahead of the curve.
Thanks, Weber. Weber, one additional point that I would like you to cover, if you can provide some commentary on what happens post longer periods of drawdowns or time corrections. And we've seen data in the past. Would love to take the audience through that.
Yeah. So in markets, there are two types of corrections which take place. One, obviously, price correction when
Thank you.
prices go down. But there is a second type of correction, which is time correction. Markets don't go anywhere for a prolonged period of time. So current market, obviously, at the headline levels shows a high degree of time correction also. September 24 to January 25, almost 16 months, zero returns to negative returns. But during the same period, earning growth has been there. If you look at the EPS growth, albeit at the lower pace, but has been there. So that means markets have become cheaper by virtue of not going anywhere. The other factor, interesting factor to look at is India's contribution to global GDP and India's weightage in global market cap. So relatively, Indian markets have become much more attractive compared to other markets. So India's GDP contribution is about 3.8%, and India's market cap contribution in global market cap has come down to 3.6%. So if you look at relatively, markets have become much more attractive. The ratio was 3.2% GDP contribution and 3.8% market cap contribution about a year ago. So that also gives a lot of comfort. When I look at relative attractiveness of Indian equity markets have come close to their long-term average compared to MSCI emerging market index. Compared to gold and other asset classes, also we are trading at below our average valuations. So all of these have set up a good foundation for market up move. And what gives us confidence is how markets have behaved in the past after a period of time stroke price correction. So if you see all these data points, when we see a drawdown from the peak, thereafter for the subsequent 1, 3, and 5 years, markets deliver extremely healthy double-digit returns. So again, we are in that scenario, and we believe that we are set up to achieve double-digit return numbers in Indian market again. It won't come without volatility because Trump will keep us on our toes. But if someone can, and we strongly recommend that we should cut out the noise and focus on year-end number. From today till year-end, your market would be in substantially higher levels.
So, Weber, to summarize, keep the outside noise out, focus on the strong fundamentals. We are fiscally in an excellent shape. The flows keep coming, especially domestic flows have been very, very strong. The corporate earnings indicators are very strong already. Some of the reforms that we've undertaken in 2025 should see impact in this year. All in all, 2026 seems to be a resounding year, and could sort of say that it's a comeback year for Indian equities. With that backdrop, Sandeep, coming back to you, investors would love to know what to do with their portfolios, right? So, from an asset allocation and investment structuring, what would some of the recommendations be from your end?
Hardik, at Deserve, we've always believed that we clients hire us to be able to give active viewpoints and actively manage their portfolios. Number one. Number two, we've also believed that we should play out the courage of our convictions. That if we have clarity and visibility, we should express that in the view that we communicate to our clients. So just to go back, when we started 2025, we started with a very risk management oriented approach to equities. We said that we will stagger deployments, and we did that for a very, very long period of time through the course of that year, right? Now, as we begin 2025, and sort of summarizing what Vaibhav said, is that we need to be in full deployment of the long-term equity capital that we have. What does that mean? If I have an allocation for equity as a part of my overall strategy, that money should be deployed almost immediately. Number one. It also means that as and when I do get capital from accumulated savings and so on, that should be SIP'd into the portfolio on a monthly or fortnightly basis, whatever is comfortable for you, right? So I think these two things are very important. Full deployment of any pending equity capital that we have in the portfolio, number one. Number two, if we have money for SIPs, we should make sure that they are allocated on a timely basis. And as some of our clients already know, do the SIP allocation fairly dynamically. Once the money comes in, depending on what is right for the portfolio at that point of time, is how the model allocates money to different mutual funds. On the equity side, we're also scaling our exposure to mid and small caps. In the last year, we were overweight on large cap. We are now reorienting that position to become a little more allocation to mid and small caps. And this will happen dynamically, automatically within the client portfolios. But as they add more capital, it will accelerate that. So if you're sitting with capital on the sideline, please talk to your wealth manager to ensure that they are aware of that. And when once you deploy it, we will use that capital to scale your mid and small cap allocation. Automatically, it will reduce churn in your portfolio. On the fixed income side, I think the strategy pretty much remains the same as what it was. In fact, we reassert that allocation to short-term bonds through and therefore focusing on accrual is what we will focus on. In fact, this terminology, the jargon around whether it's accrual or duration, duration essentially invests in long-term government bonds, hoping for an interest rate drop to happen. We don't think that will happen in the near term, or much more room for interest rate corrections isn't there. So what therefore we are doing is we are investing in short-term bonds. This will happen through the deserved dynamic debt plus strategy. So if you have allocation for fixed income in your portfolio, please continue to deploy it here. On the arbitrage side, I think it's a great place to park money over fixed deposits from a tax efficiency perspective. So if I have money for more than a month or a couple of months, arbitrage funds are a great place to do it. We have deserve arbitrage strategy, which manages that portion as well. And lastly, there's also this open question around precious metals. Obviously, there periodically there can be risk in the markets. Precious metals sort of can buffet that risk a little bit. We think that the overall portfolio allocation to precious metals should be up to 10%, but that can be staggered now. We don't need to go into an upfront deployment on precious metals given where the prices are. In fact, there's this very interesting metric that we put out in our December note of what does it or how many grams of gold does it cost to get 1 unit of Nifty 500, and that number is at historic lows, which means that gold is expensive relative to equities. Having said that, it should have an allocation in the long-term portfolio, but that deployment does not need to be upfronted.
Uh, Great, Sandeep. Any parting thoughts on pre-IPO or unlisted equities?
I think, Hardik, you know that you've been close to it. We remain constructive. We keep looking for the right opportunities and ideas here. However, it's very, very important to be super selective on this side. We cannot think of this as an asset class by itself. We cannot say that X amount of money has to go into pre-IPO as a part of the portfolio. The way we demonstrate conviction on the public markets equity side, that same thing on the pre-IPO side cannot be there. So you have to be opportunistic. We are in a unique position where we are fortunate to be able to see most of the deal flow that is happening in the category. We have seen a bunch of new economy companies. We've seen legacy financial services companies. And I think that's something that we are keeping an eye open for. I think that in the course of the coming year, we will come out with some opportunities for our clients to deploy there.
Great. Thank you so much, Vaibhav. Thank you so much, Sandeep, for walking us through 2025 and the outlook for 2026. Uh, for the audience, the floor is open for questions. Some of you I see have already posted on the Q&A box. Would love to take as many questions as possible in the remaining 20 minutes. We'll try and stick to macro asset classes, segments within asset classes, so that we are able to make this productive for rest of the audience as well. Let's begin with the Q&A. Sandeep, Vaibhav, I'll take the first question, which is around the performance of the rupee and its impact on overall performance of the Indian equities.
Vaibhav, do you want to take it?
Yeah, sure. So, contrary to popular belief, the rupee depreciation is not such a bad thing for Indian equity earnings because impact of rupee depreciation is positive in terms of earnings of the companies. So every 1% depreciation in rupee will add about 2 to 3% earning growth for export-oriented business, and the impact at the index level is almost 0.4 to 0.5% positive. Now, rupee depreciation has two parts to it. One, fundamental factors, and second is obviously technical factors. India's currency depreciation over last 6 months has happened largely on account of technical factors, which was large FPI outflows. Nothing to do with fundamental factors because our current account deficit remains under control, domestic inflation remains under control. The spread between US 10-year and India 10-year is very, very narrow. Our inflation is lower than US inflation. So most of this correction is technical. Third thing is it's in government's interest to keep the currency weak to buffer the impact of tariff increase. So that also is an important consideration. So while we are looking at the headline and it comes across as a negative factor, but these are all strategic moves which are taken into consideration while deciding the levels at which rupee should go to.
I think
Vaibhav,
the
sorry, sir.
broader point is also like Vaibhav was saying that, and we referred to in our 2025 summary that the state has truly stepped in, whether it is on the fiscal side or on the monetary side, and now also on the currency side. The state has let the rupee depreciate, which is positive for exports. There's also sufficient balances with RBI and forex reserves. Nearly $700 billion sits with the RBI. So I think India is relatively well positioned to see through volatility, but lower rupee by itself is not necessarily a bad thing.
And we don't necessarily believe that RBI or the government should step in to control the market levels.
See, they would intervene if commodity prices get out of hand. So, if as long as crude prices remain under control, and which they have been, RBI doesn't have any pressure, and which is reflected in inflation numbers also. If you look at the inflation numbers also, despite a weak currency, inflation has remained benign. So, we're not importing inflation, which would have been the concern for RBI.
Got
If
it.
there is any change in that dynamic, then regulators will step in.
Vaibhav, then a related question, which, of course, given the backdrop of events that occurred over the last 7, 10 days with the US seizing or capturing the Venezuelan president, any impact on crude and corresponding impact on so let's actually look at impact on inflation earnings and then corresponding impact on India equities.
So I'm not a geopolitical expert, but whatever I've read, it indicates that with Venezuela coming under US control, supply of crude oil is going to increase. And if the supply increases, obviously the prices should correct. But in short term, volatility can ensure that crude prices go up because geopolitical uncertainty always results into crude prices going up. As the dust settles down and supply stabilizes, then the prices should naturally come down, and therefore it should impact India positively.
Fair. One of the common questions that I see is view on global equities, especially US and the China, given where the performances were over the last year, how India fared. But of course, we need to look forward. So, any view that we can build on global equities?
See, US markets are expensive and are also vulnerable. So whatever Trump is doing is going to impact US much more than any other country. So those risks are there. And when we combine these two with a significant valuation premium and no margin of safety, I would stay away from US markets. Uh, Other markets, China is looking interesting, but honestly, in India itself, the opportunity is reasonably comfortable for the current year. So I would go overweight on India and only for some satellite allocation. If you want to have global equity exposure, you can have. Right now, India looks in the best place to have any equity exposure.
Fair. And even for satellite exposure, above the avenues to actually access investment without paying a significant premium or without going through multiple regulatory hoops is incredibly difficult.
No, absolutely. That's another point. The issue is many ETFs, global ETFs, which are available in India through fund of fund structures, are trading at a substantial premium to their actual NAV. Premium is as high as 15 to 20%. And most of these funds are shut for subscriptions also because RBI has defined a limit of $7 billion cumulative. And that limit is more or less exhausted for most of the funds. Some of the funds which are available are obviously A, are not very good funds, or B, are not investing in US markets necessarily. Some of these funds invest in emerging markets, which has again weightage to India. So very
And
few
given that,
options.
India has underperformed the emerging market index by possibly the highest margin since, or even before I started my career in the 1990s. So I think relative to other emerging markets, I think we should definitely deploy in India.
Got it. Coming to equities within India, some of the questions are around allocations to different market cap segments. Uh, Obviously, there has been different correction in different market cap segments, as we saw in one of the slides. But some of the apprehensions or anxieties around small mid cap having higher Ps compared to large cap continue to prevail. How should one look at allocation between these segments?
Okay, so two things. The best thing about Indian markets this year is that there's incredible amount of skepticism around Indian equity market, and which is always a great thing for future returns. So as they say, bull markets are built on the foundation of skepticism. So I'm happy that there's a lot of skepticism around Indian markets. It's completely different from what we witnessed in 2024, where all of us were in a zone where nothing could go wrong with Indian
Mhm.
equity market. So that's point number one. Point number two, you have to have an allocation to all three categories. What I was trying to say earlier, and I'll reiterate that point, is that it will be a stock specific market. So you
Right.
don't have to look at the broader market and say, should I invest in this segment or that segment? It will be a stock specific market. Large cap continues to have highest margin of safety, but will have lower growth. Mid and small caps, there are stocks which have corrected substantially and are exhibiting high earning growth. And when we look at the disconnect between valuations and earning growth, that has reduced substantially, which means now earning growths are reasonable and valuations have become reasonable in the context of the potential earning growth. Net net, at our ERS strategy level, we are maintaining 63 to 65% allocation to large cap and 30 to 35% allocation to mid and small caps. So that's our recommendation and view on flagship strategy. However, it's subject to change when the market environment changes. So we may go more aggressive or may stay at current levels depending on how the markets shape up. We are also recommending allocation to Constellation Fund, Deserve Constellation Fund, which is one of its kind, where we give money to boutique fund managers to invest in select mid and small cap opportunities. And that is something that investors should consider because that's a very stock specific approach of investing in mid and small cap segments where each company is analyzed instead of a broader market participation. So that's the thought.
Vaibhav, just to add to your point on the stock specific, and I think it's important for our clients to understand what that really means. Between 2020 and 2022-23, we saw this time frame where practically any stock that you held in your portfolio did well. The entire spectrum of market moved up courtesy of liquidity infusion that happened globally, right? Now, today, when we look at stock heavy portfolios, which clients share with us before they onboard, we realize that a bunch of these portfolios, in fact, a majority of them, over 65 to 70%, are actually underperforming benchmark indices, right? And when Vaibhav says stock specific market, it actually means that managing direct equity portfolios will become harder than ever before, right? It will
Absolutely. Yeah.
it will need a lot of expertise to be able to manage this. Uh, Mutual fund managers have access to deep research. They have access to technology to be able to do this work in the context of now a much larger listed universe of stocks, right? That if we complement with boutique fund managers through the fund of fund vehicle that Vaibhav referred to, I think can create a very interesting opportunity. But I would strongly recommend every client to review their direct equity positions and see if they are actually able to spend the time analyzing individual stocks and taking deep views on individual positions that they have. If not, that money is better managed by expert fund managers on the mutual fund side or on the boutique strategy side.
No, that's a fair point, Vaibhav and Sandeep. I think we are not in a period where everyone and their dogs could just randomly pick stocks and they would hit benchmark or beyond that return. This is a period where expert advice on how to sort of go about navigating your portfolios could be of significant value add. Uh, uh, moving on to the next part where some of the questions are around sectoral allocations. Do we have a view on sectoral allocations? Is it best left to the fund managers? They are obviously looking at indicators, be it around GST or around consumption or around monetary policy, which could impact financial services and other players, and navigating allocation to different segments meaningfully at their level itself. Should us as investors at our level also look at thematic funds or look at sectoral allocations?
See, we want to select fund managers which can operate in unconstrained environment. By unconstrained environment, I mean fund managers should be free to go to any sector, any theme where they see value. Obviously, we don't want a situation where fund managers are constrained and are forced to invest in a sector or a theme, even if their conviction is low, because the offer document constrains them to investing in only those sectors. Now, the issue with some of these themes and sectoral funds is fund managers don't have any choice, and most of these themes and sectoral funds become popular only at the peak of their performance cycle. A good data point to look at would be defense funds performance post last year's NFOs. All the defense funds, and there were a bunch of defense funds which were launched last year, all of them are trading in deep negatives now. So, which means that timing these funds is very difficult. And whether the fund manager has conviction or not, he will continue to stay invested in that theme only. So, we generally stay away from those. What we look at is what are the segments of the markets which has favorable tailwinds from macro point of view, and what are the segments of the market which has headwinds from macro standpoint. We want to go overweight on funds which are invested in themes or segments where we have higher conviction in terms of macro regime. So, unconstrained investing for fund managers, select fund managers whose portfolio is going to benefit from the tailwinds is a better approach compared to investing in thematic funds, because you will keep churning your portfolio again and again, and which will keep uh, creating cost pressure also, and at the same time probabilities also run out of your favor very soon.
Fair. Sandeep, this question around the next part of the asset allocation, which is debt. One, of course, we mentioned about playing accruals and not duration. There are a couple of questions around allocations towards fixed income through REITs, InvITs, and infra yield assets. A little bit of color on that would help.
So first of all, the Deserve Dynamic Debt Plus strategy not only allocates money to bonds, but also does have some allocation of up to 15% to InvIT, REITs, etc. Right. So in a way, for clients who are allocating to that strategy, our fund management teams are constantly evaluating opportunities in this category. Having said that, we have a dedicated infra yield strategy also, which specifically and exclusively invests in InvITs and REITs. And that strategy has also had fairly healthy returns. I think our return profiles are available on the APMI website, and we can also share it with you. But I would suggest that for somebody who has a broad fixed income allocation, the Deserve Dynamic Debt Plus strategy pretty much gives you all the exposure that you need. Only for clients who do not want to invest in bonds and exclusively want to do infra yield, we can allocate money there. If you were allocating money only to InvITs and REITs, it can potentially, as a part of the long-term portfolio, be between 5 to 10% of the overall allocation.
Got it. Moving on to the hot topic, gold, silver, copper. Weber, we've covered precious strategy as part of one of the asset allocation segments. Any deeper guidance on what should one do with silver? Is copper one of the other commodities that we need to look at within this strategy? Should investors look at it separately?
So in India, there is no mechanism to invest in copper, so I'll leave that out. Gold and silver we manage through our Shine strategy, and where we dynamically change allocation between gold and silver depending on the gold and silver ratio, which is a popular investment ratio, which is followed by a lot of global indices also. So investors don't need to worry about that. Invest money in Shine strategy, and we'll manage the allocation across both of these precious metals dynamically. We should continue to have allocation to precious metal. We've guided 10% allocation to precious metals. The reason is not that we believe that it will deliver substantially higher returns, and one should not invest in these asset classes with that assumption. The assumption here is if things go wrong, these asset classes will ensure that your returns are protected, your capital is protected, and in the times of uncertainty, they can double in a matter of time. So 10% can pretty much become 20% very easily in a short period of time. Geopolitics is a big driver of returns in these asset classes, and given the state of geopolitics, we recommend 10% allocation to these asset classes.
Got it.
Also, Hardik, I think we're looking at gold on the back of a very, very strong rally.
Yeah.
It's also, unfortunately, we have enough gray hair to have remembered that there are times when gold has given significantly negative return for extended periods. We remember, I think the 2015 period, Vaibhav, and correct me if I'm wrong. Also, 2008, we saw a deep correction in gold. And even when I was starting my career in the early 2000s, gold had not done really well. So I think it's important to know that at the end of the day, it's asset allocation that trumps everything else, and not to get carried away by an asset class that has done really well in recent time.
Sandeep, that brings me to the next question. I've seen a couple of our members from the audience asking about oscillating between different asset classes.
Hmm.
Would it be prudent to suggest that we move to debt until we see valuations? Of course, in this time period, valuations are already reasonable. But would you suggest oscillating between different asset classes, or should it be a static asset allocation, or the asset allocation has other variables for you to determine where do you park the money? How would you sort of respond to that?
So, Hardik, this is essentially the question that we've been trying to answer for the last 20 years that we've been doing this, is what's the best way of managing asset allocation? I'm glad that question is coming up because honestly, that's the biggest determinant of return, rather than which specific stock or which specific mutual fund or which strategy will do well. Now, the way we think about it is that there are two aspects to it. One is what is the tenure for which I'm investing, number one. And number two, which is I think more important, is how can I handle volatility or downside myself, right? One of the biggest investment philosophers of our time, Morgan Housel, says that personal finance is more personal than finance. We cover a lot about the financial aspect, which is how you should allocate and so on. But the real thing here is if I have volatility in my portfolio, if markets are significantly down, will I be able to handle that downside? Or do I have a great wealth manager who will help me handle that downside, right? Now, the way we think about it, therefore, is that long-term deployments, which is money more than 3 years, should be heavily oriented towards liquid public Indian equities, which is, and that number can vary from 60% to 75, 80%, depending on how much volatility I can handle. The balance of the long-term money or greater than 3-year money should be deployed in fixed income and gold, silver, etc. Right? So that's the broad construct. Now, every time the portfolio deviates from this particular threshold is when we rebalance. So let's say if I have agreed that 60% of my portfolio should be equity, because of other assets doing well or equity not doing well, that number comes down to 55%. At a periodic intervals, I need to top up that remaining 5% and bring it back to 60%. So that prudence, I think, and periodic rebalancing is required, which is the reason why we request our clients that a quarterly review with your wealth manager to go over the overall asset allocation is, I think, very crucial. And every 6 months or 1 year, just to rebalance back to that asset allocation that you've set up yourself for, I think is very important.
Great. I think we are at the top of the hour. I'll quickly take a couple of questions and we'll close it for the day. Is Deserve looking at SIF? Weber, you want to quickly cover this?
Yeah, we are looking at SIFs and we will come up with a dedicated SIF only strategy soon enough. We are waiting for some scale up in AUM across various AMCs so that we can have meaningful allocation to them.
Perfect. Questions around some of the portfolios may have more than 7 to 10 recommended mutual funds. You will have to wait for your rebalancing tenor. You can speak to your relationship manager who will explain the rationale behind the timing of the rebalancing because there is a cost benefit analysis that goes into that. Uh, View of investment in crypto. No, we don't cover crypto. That's not a regulated asset class. We only look at regulated asset categories in India. I think that would be it. We are already 2 minutes over and above our time. Thank you so much, Vaibhav and Sandeep, for taking us through a lot of the questions around asset allocation, around macro and geopolitical factors. I'm sure we are wiser than we were uh, 1 hour prior to this. Thank you, the audience, for being so participative. Several questions help us bring about insights which were more productive to the rest of the audience as well. Thank you for spending 1 hour in the morning on a Saturday with us. Hope to see you guys soon. Thank you so much.
Thanks. Thank you. Thank you everyone for joining in.